Welcome to the Deep Dive. Today, we're really jumping into something that caused quite a stir.
Yeah, big news.
The sudden, really dramatic fall of HIMS stock, Here's Health Inc.
Mm-hmm.
And this wasn't just, a small dip. It was a serious plunge. Really caught people by surprise.
Absolutely, a shockwave.
So our mission here is, well, pretty straightforward. We want to unpack why this happened, the specific reasons.
Right, get behind the headlines.
Exactly. And then figure out, does this look like a buy-the-dip chance for you? Or is it something else?
Yeah, is there an opportunity hidden in the wreckage?
We want to give you a really solid grasp of all the moving parts here, especially in this fast-changing digital health market.
And we've looked at a lot of different angles. Real-time financial data, of course.
Yeah, and reports from places like The Motley Fool.
Plus technical charts from StockScan, TradingView.
Analyst insights, even chatter from social media like X, trying to get the full picture.
It's definitely a complex story. Our job is to kind of boil it down so you understand not just the what, but the why, and what it might mean for HIMS going forward.
Okay, let's start with that initial shock, the
Wow.
plummet itself, June 23, 2025. What were the actual numbers? It felt like falling off a cliff.
It really did. The numbers are pretty stark. HIMS closed that day at $41.98.
Okay.
But just 3 days earlier, June 20th, it was sitting at $64.22.
Wow.
So yeah, that's a drop of roughly 34, maybe 35%. Incredibly fast. For a stock that had been flying high, that's a huge loss of value.
Okay, so what was the main trigger? What kicked this off?
Well, the primary catalyst, according to the Motley Fool and other reports, was a huge announcement from Novo Nordisk.
Ah, the drug company.
Exactly. They
That's-
terminated their partnership with HIMS.
Terminated completely.
Completely, and specifically, they prohibited HIMS from selling compounded versions of Wegovy.
Wegovy, the big weight loss drug.
Right, the really popular GLP-1 drug, yeah. So HIMS was essentially cut off from offering these compounded versions.
And that was a big piece of their business,
Yeah.
right? Especially the growth part.
It was a significant growth driver, absolutely. So being cut off like that, well, first, why did Novo Nordisk do it?
Yeah, what was their reason?
Their stated reason was pretty direct. They alleged HIMS failed to comply with certain standards, posing potential patient safety risks. That's the official line.
Patient safety risks. That sounds serious.
It does. And like you said, Wegovy was a major engine for HIMS. So this news just sparked widespread panic selling. It pulled the rug right out.
So, okay, the Novo Nordisk bomb dropped. But was the stock already maybe vulnerable? Did its past performance or other pressures make the fall worse?
That's a really interesting point because, yes, the stock's history actually kind of set it up for a harder fall.
How so?
Well, HIMS had this incredible run before this happened. It went from around $20 back in June 2024
Right.
all the way up to a high of nearly $69 in February 2025.
Huge gains.
Huge, but that pushed its valuation way up. We're talking a market cap of like $13.38 billion. And a lot of market watchers felt it was, frankly, overvalued, stretched thin.
So like a balloon ready to pop.
Sort of. That high valuation made it extremely sensitive to bad news. Any negative catalyst was likely to have an amplified effect. And this Novo Nordisk news was definitely a major negative catalyst.
Right, not just any bad news. Okay, so it's perched high. Did the technical charts, the market signals, show any warning signs beforehand? Or did they just pile on after the news broke?
Oh, there were definitely warning signs flashing on the technical side. StockScan, for instance, showed HIMS's RSI, the relative strength index.
Momentum indicator.
Exactly. It hit 76.78. Now, for chart watchers, anything over 70 is generally considered overbought.
Meaning a pullback might be coming.
Precisely. It suggested the stock was maybe due for a correction, that investors might start taking profits, so that technical pressure was building underneath.
Interesting. Any other signals?
Yeah, TradingView's AI model was flagging a moderately bearish short-term trend even before the big drop. It had, I think, 14 technical indicators pointing towards sell.
14. Wow.
Yeah. And another thing, trading volume. On June 20th, just before the plunge, the volume actually decreased from its earlier highs.
So price was high, but fewer people were trading.
Exactly. That's called price-volume divergence.
Yeah.
It often signals that conviction is weakening, that the upward momentum might be stalling. It can foreshadow a pullback.
So the setup was there. High valuation, overbought technicals, weakening volume, then boom, Novo Nordisk.
That's a good summary. The catalyst hit a vulnerable spot.
Okay, let's broaden out a bit. What about the general environment, competition, regulations?
Yeah.
Did those play a role too?
They definitely form part of the backdrop. You can't look at HIMS in isolation.
Right.
There's increased competition across the board, not just in weight loss, but other areas HIMS plays in. Like GoodRx launched ED products, competing directly.
Okay, more rivals entering the space.
Mm-hmm. And remember, there was already some regulatory heat. Back on May 22nd, there was that decision prohibiting the mass production of Wegovy generics.
Right, I remember that.
Now, HIMS wasn't using generics. They had the partnership for the real deal, supposedly compounded. But this termination by Novo Nordisk, it kind of reignited those worries about HIMS's whole model, especially its reliance on compounded drugs.
Ah, so it brought back those earlier concerns with more force.
Exactly. Casts a shadow of uncertainty over how sustainable that part of the business is.
And what about things HIMS itself was doing? Any internal moves that might have added pressure, even if they were meant to be positive long term?
Yeah, that's another layer. Even strategic moves can have short-term costs or impacts.
Like what?
Well, HIMS announced a workforce reduction, about 4%, back on May 30th. They said it was to address regulatory changes and improve efficiency.
Okay, belt tightening.
Right. And they also acquired Zavia, that European digital health platform.
For international expansion.
Exactly. Aiming to grow in the UK, Germany, France, Ireland. Definitely strategic long-term plays. But in the short term, acquisitions and restructuring, they cost money, they can increase operating expenses, maybe hit profitability initially. So that adds another bit of pressure, another thing for investors to worry about just as this big negative news lands.
Okay, so it feels like a perfect storm almost. The specific catalyst, the high valuation technical warnings, competitive heat, regulatory shadows, and even some internal cost pressures.
Yeah, a confluence of factors made this drop particularly severe.
All right, we've unpacked the fall. Let's pivot now. What about the core health of the company itself? After a hit like this, are there still strong fundamentals holding things up, or is it looking shaky underneath?
That's the crucial question, right? And it's definitely not all doom and gloom when you look under the hood. HIMS still has some, well, surprisingly strong fundamental points.
Okay, like what?
Subscriber growth, for one, still very impressive. They hit 2.4 million subscribers in Q1 2025.
2.4 million. How does that compare?
That's a 38% increase year over year. So despite everything, there's clearly strong demand for their basic telehealth services. That core business seems solid.
38% growth is significant. What about revenue?
Also very strong. Q1 revenue was up 111% year over year, hitting $586 million.
Oh, 111%.
Yeah, and that actually beat expectations. Analysts were looking for around $539 million.
Oh, they blew past estimates even recently.
They did, and they're projecting around $550 million for the next quarter. So the underlying growth, even post-Q1, they expect it to continue, maybe just not at that explosive rate. The core story isn't completely broken by the Wegovy issue.
Okay, strong user and revenue growth. You mentioned the Xavier acquisition earlier as a potential pressure point. But isn't international expansion also a fundamental positive?
Absolutely. That Xavier deal is key for the long term. Getting into the UK, Germany, France, Ireland, that diversifies their revenue significantly.
Reduces reliance on the U.S. market and maybe some of those regulatory headaches.
Potentially, yes. It opens up big new markets and could be a major growth engine down the line. And financially, the company looks pretty stable too.
How so? Debt. Cash.
Very low debt, only about $63 million, which is tiny, like 0.5% of their market cap.
Okay, not leveraged to the hilt.
Not at all. And they have substantial cash reserves. Cash makes up over 36% of their total assets.
So they have a cushion.
A pretty good cushion, yeah. Which is vital when you face turbulence like this. Financial stability is there.
Okay, that paints a more resilient picture. Strong growth, international plans, solid finances. But obviously the market reacted very negatively. What are the big red flags on the fundamental side that counterbalance these positives?
Well, the biggest one, you just can't ignore it, is the Wegovy setback.
Right.
Losing that revenue stream, even if the exact contribution wasn't public, it's clearly significant. It's almost guaranteed to hit income in the short term.
And investor confidence.
Massively. The market needs to figure out how much that hurts and how quickly HIMS can replace it. That takes time and creates uncertainty.
Okay, what else?
Profitability. Despite that huge revenue growth, HIMS wasn't hugely profitable yet. They turned profitable in 2023, which is good, but their operating profit margin was only 6.2%.
How does that stack up?
Well, compare it to the S&P 500 average, which is around 13.2%. So HIMS has a long way to go to improve its core profitability to turn that revenue into solid earnings.
Room for improvement there, definitely.
And then we circle back to valuation risk. Even after this massive drop to around $42,
Yeah.
it's still up about 211% from its 52-week low, which was down near $13.50.
So it's still way up from where it was a year ago.
Way up. And look at the analysts. Their average price target is currently around 38 cents.
Below the current price.
Yeah, and some forecasts go as low as $23. So even after the plunge, there's a strong argument that the stock might still be elevated relative to its near-term earnings potential, especially with the Wegovy uncertainty.
So the market might think it needs to fall further to be fairly valued.
That's certainly a major risk investors are weighing. The floor might not be in yet.
Okay, understood. Fundamentals are mixed. Strong growth metrics, but real concerns about the Wegovy hit, profitability, and lingering valuation questions. Let's shift, again, back to the technicals and market mood. What are the charts saying now, post-plunge? Where might it go from here?
Well, the technical picture is still pretty tense. That intraday low on June 23rd, around $40.68.
Yeah, just above $40.
That's really close to a known support level around $40. Holding that level is critical in the short term.
What happens if it breaks below $40?
If it breaks decisively below $40, that could open the door to further declines. The next major technical support zone people are watching is lower, maybe down around $30 to $31. Some folks on X were pointing to that zone.
Okay, so $40 is the immediate line in the sand. What about resistance on the way back up if it bounces?
If it tries to rebound, it'll likely face resistance fairly quickly. That intraday high on the plunge day was near $46.70, so maybe resistance starts building around 45, 46 cents.
So tight range, potentially. What about the overall trend? Still bearish?
Short term, absolutely bearish. The momentum is downwards. But interestingly, some longer-term analyses still view the trend over the past year as bullish, based on that upward channel it was in before the break.
So a conflict between short-term damage and maybe a longer-term uptrend that could resume.
Could. It's a real tug-of-war scenario on the charts right now.
What about the professionals, the analysts, and the sort of collective wisdom or madness of social media? Does that align with this mixed technical picture?
It kind of does, yeah. Analyst consensus right now, if you look at market beat or tip ranks, is basically a hold.
Not a buy, not a sell. Just wait.
Pretty much. The breakdown is something like 2 buys, 7 holds, and 2 sells. So caution dominates.
And that average price target is $38, you said.
Right, $38, which again suggests they don't see a quick snapback rally above the current price. It implies maybe more sideways action or even further downside as possible first.
And social media? More optimism there or just fear?
It's mixed, as you expect. You see some users, like One Handle at the Long Invest, expressing long-term belief in HIMS. They talk about potentially adding shares if it drops to those lower support levels, like $30, $31, or even $25.
So planning to buy the dip, but maybe a deeper dip?
Exactly. Acknowledging the short-term pain, but keeping faith in the long-term story. But there's also plenty of fear and uncertainty being expressed too, so sentiment is fractured.
Okay, one last piece of context. This huge drop for HIMS, was it part of a wider market sell-off, or was it really just about HIMS?
Oh, it was definitely company-specific, no question.
How we know?
Because on June 23rd, the day HIMS cratered, the overall market was actually up. The S&P 500 gained about 0.8%. The NASDAQ was up 0.7%.
Okay, so the market was fine, HIMS was not.
Precisely. This wasn't a market is crashing, taking HIMS with its situation. This was a HIMS-specific problem hitting the stock hard.
But you mentioned its beta earlier.
Right. HIMS has a high beta, around 3.22, which means it's much more volatile than the overall market.
So even if the market just wobbles a bit now.
HIMS could swing much more wildly, both up and down. That high beta amplifies everything. It adds another layer of risk for anyone thinking of jumping in.
Okay, that brings us to it. The million-dollar question, as they say. For you, listening right now, maybe holding HIMS or thinking about it, is this actually a buy the dip opportunity? Or is it more like catching a falling knife? What's the potential upside case here?
Yeah, this is where the rubber meets the road for an investor. The buy the dip case rests on a few things.
Okay.
One, HIMS's ability to adapt. Can they pivot quickly? Launch other weight loss products? Can they really leverage that Xavier acquisition to ramp up European revenue faster than expected to offset the Wegovy loss?
So resilience and execution.
Exactly. Two, the current price. It's around $42 now. That's getting closer to some of those analyst targets, the $38, $43 range. If it does fall further into that $30, $35 zone,
Then it looks more attractive.
it could become significantly more attractive, especially for long-term players. And three, the bigger picture. The long-term tailwinds for telehealth are still there. That idea of HIMS becoming an Amazon for healthcare, a digital front door, that potential hasn't vanished.
The platform strategy.
Right. If you believe in that long-term vision, a dip like this could be the entry point you were waiting for.
That's the bull case. But the risks, they sound pretty significant too. What's the other side of that coin? Why might this not be the time to buy?
Oh, the risks are absolutely substantial. You have to be clear-eyed about them.
Laying them out for us.
First, the immediate financial hit. We don't know the full impact of losing the Wegovy compounding business yet. Revenue and profit are likely to decline in the near term. The market might punish the stock for several quarters until there's clarity on growth recovery.
So prolonged uncertainty and pain.
Could be. Second, that technical risk we talked about. Breaking below $40 support could trigger automated selling, stop-loss orders. It could cascade lower, making it very hard for the price to find a footing.
Catching that falling knife.
Exactly. Third, the ongoing industry headwinds. Competition isn't going away. Regulatory scrutiny around compounded drugs might intensify, not just for HIMS, but for the sector. These could keep a lid on the stock price.
Okay. Anything else?
Yes, short interest is really high, around 33.86%.
A third of the float is betting against it.
Roughly, yeah.
Huh.
That signifies huge bearish pressure. Short sellers can actively push the price down, and it makes any rally attempt much harder because they might sell into it. High short interest equals high volatility and risk.
Okay, that's a sobering list of risks. So let's talk strategy. For someone with a shorter time horizon, maybe looking 1 to 3 months out, what's the approach?
Short term, I'd say caution is definitely the word. Probably best to avoid jumping in immediately to buy the dip.
Why?
Because the stock is incredibly volatile right now. The technicals are weak, sentiment is negative, and that risk of breaking below $40 is very real.
So sit on the sidelines for a bit.
I'd lean towards a wait-and-see approach. Let the dust settle. See if it finds some kind of base. Maybe if it tests that $30, $35 range and shows signs of stabilizing, like a strong rebound on high volume, or the RSI dipping into truly oversold territory and turning up.
What should you be watching for specifically?
Definitely watch what HIMS management says and does. Any concrete plans to replace the Wegovy revenue, new product launches, updates on Xavier integration, and keep a close eye on the price action and trading volume day to day. Look for signs the selling pressure is easing.
Okay, patience and observation for the short term. What about the long-term investor? 6 months, 12 months, maybe longer. Is the picture brighter there?
For the long term, I think you can afford to be cautiously optimistic, maybe.
Cautiously optimistic. Why?
Because those fundamentals we discuss, the strong user growth, the revenue trajectory before this hit, the decent financial health, the international potential, those haven't disappeared entirely.
The core business is still growing.
It seems to be, and the overall trend towards telehealth isn't reversing. So if you believe in HIMS's platform and management long-term, this pullback could be an opportunity.
So how would a long-term investor approach it?
May consider phased accumulation. Don't go all in at once. If the stock does pull back further, maybe below $30, getting closer to its 52-week average around $30.50, you could start building a position gradually.
Dollar cost averaging on the way down.
Something like that, yeah. But the key event will be the next earnings report, probably around August 11th.
What are you looking for there?
You need to see continued subscriber growth, updated revenue guidance that accounts for the Wegovy hit but still shows resilience, and importantly, real progress on that European expansion via Xavier. If those numbers look solid, if they show a clear path forward, that could be the catalyst for the stock to start regaining trust and momentum.
Got it. Crucial earnings report coming up. Now, for anyone listening, if they do decide to act, whether short-term or long-term, risk management is critical with a stock this volatile. What practical steps should you take?
Absolutely paramount. First, if you buy, set a clear stop-loss order immediately.
Where?
It depends on your entry, but maybe 5% or 10% below where you buy. Or you could place it just below a key support level, like that $40 mark initially, or maybe below $30 if you wait for a deeper dip. The point is, define your maximum acceptable loss upfront and stick to it.
Protect your capital.
What else? Position sizing. This is crucial with high volatility stocks. HIMS's weekly volatility is around 15%. That's higher than 75% of U.S. stocks.
So don't bet the farm.
Definitely not. Limit your initial position. Maybe start with just 2% or 3% of your total investment portfolio. You can always add more later if it starts performing well and your thesis holds up. Don't take an oversized risk right off the bat.
Makes sense.
And finally, diversification. Don't put all your eggs in the HIMS basket, especially now. Consider spreading capital across other names in telehealth or healthcare tech, maybe Teladoc, maybe Zeta Global, others. It helps mitigate the risk if HIMS specifically continues to struggle.
Good practical advice. Stop loss, size appropriately, diversify. Okay, as we wrap up, what are the absolute key things our listeners should keep their eyes peeled for in the coming weeks and months? The main signals or events?
Okay, key things to watch. First, company communications, especially anything from the CEO, Andrew Dudum. He was on X expressing disappointment about Novo Nordisk's claims, emphasizing platform integrity. Watch for any follow-up actions, legal moves, or specific strategic responses from HIMS.
How they fight back or adapt.
Exactly. Second, broader industry stuff. Any new regulatory changes affecting weight loss drugs or compounding pharmacies? What are competitors like GoodRx doing? What's Novo Nordisk's stance with other partners? The whole ecosystem matters.
Context is key.
And third, keep watching those technical signals. Is the RSI or CCI hitting oversold levels? Do we see any bullish reversal patterns forming on the charts? Like a hammer candle, small body, long lower shadow, or a morning star pattern, which is a 3-candle bottoming signal? Those could indicate selling exhaustion and a potential bounce.
So company news, industry dynamics, and chart signals.
Those are the main things to monitor closely right now.
Okay, so let's try and summarize this deep dive. The huge HIMS plunge.
Yeah.
It was really sparked by that Novo Nordisk partnership termination.
Yeah, that was the main catalyst.
But it was made much worse by the stock's already high valuation and some flashing technical warning signs.
Right, the conditions were right for a big reaction.
Looking ahead, short term, extreme caution seems warranted. Waiting for the dust to settle, maybe for a clearer bottom to form, seems prudent.
Definitely risky in the immediate term. Wait and see makes sense.
But longer term, there's still a case for cautious optimism based on underlying growth in users and revenue, the international plan, and the potential of telehealth overall.
Cautious optimism, yes, but dependent on execution and seeing proof in the upcoming earnings.
Which really leaves us with the big question, doesn't it? As healthcare keeps evolving, more remote services. How do companies like HIMS navigate this? Balancing that drive for rapid growth and innovation against really strict safety standards and regulations.
That's the fundamental tension, isn't it? Growth versus governance and safety.
And what does that balance, or maybe imbalance, mean for how you, as someone watching this space, evaluate their real long-term potential? It's not just about the numbers.
It really isn't. It's about trust, sustainability, and navigating a very complex landscape. Something important to think about.
A vital question indeed. We hope this deep dive gave you the tools to think through it. We encourage you to keep exploring. Thanks for joining us on the deep dive.